Thank you for joining us. The following presentation is from a webinar titled Life Insurance, Trends, Tips, and Review, originally produced on September 10th, 2015. The presenters are Greg Lowe from McKonly Asbury and Donna Wanamaker and Rachel Lower from 1802 Insurance. Enjoy the presentation and visit us online at www.macpas.com for more information about our future events and upcoming webinars.
Thank you, Tyler, and welcome to everybody that has joined the call. It's my pleasure to welcome again to our office today Donna and Rachel. I've worked with these ladies for a number of years and really happy to have their insurance expertise with us today. They have a lot of great information for you today, and I'm just going to make one note about questions before we dive in. You can submit questions at any time during the presentation, and we're going to try to queue those up and get to as many of those questions as we can. In the event that there's something specific that you want to ask that wouldn't be appropriate for the overall webinar, we will take some good notes, and we have your contact information, and we'll get back to you individually on those sorts of questions, and we'll just deal with those questions as they come up and with any time that we have remaining at the end. So without further ado, let's dive in. And Donna and Rachel, welcome. And maybe you could just give us tell us a little bit about yourself before we dive into these slides.
Sure. Thank you, Greg, and thank you for having us today. I'm Donna Wanamaker, and I've been in the insurance industry for 35 years, and the last 32 of that with Cornerstone Advisors and 1802 Insurance.
This is Rachel Lower. Thank you for having us as well. My background is in actuarial science. I have been in the life insurance industry for over 16 years, the last 15 with 1802 Insurance and Cornerstone.
All right. Well, thanks again for coming. Why don't you tell us a little bit about what you have in store for us today?
You know, Greg, over the last 20 years, or actually the 35 years that I've been in the insurance industry, so much has changed with life insurance products and in the industry itself that most of the normal people out there are unaware of how these changes have affected them and their policies. So what we'd like to accomplish today is to remove the confusion of the life insurance products and these changes because we find that life insurance policies are really the most neglected financial asset. And although it's probably one of the most important financial assets a person can hold. We hear from new clients all the time when we ask them what kind of insurance portfolio they have. They say, generally, I have whole life. And once we delve into working with them, we find oftentimes that they don't have whole life and they're really unaware of what type of policy they have. And unfortunately, it's sat in a drawer for the last sometimes 10 years. The risks in insurance policies have been shifted over the last 20 years from the insurance company to the policy owner. So the key is to understanding what those risks are and the possible pitfalls of each product.
Okay. So you mentioned whole life, and I know you're going to do a good job today of defining terms for us, but let's start there. What do you mean by whole life?
Well, let's start with a slogan from a particularly popular commercial on TV today, and that is, what you don't know can hurt you. So as Greg said, let's start with a little history lesson. Oh, let me just back up there. We have our mandatory disclosure page. Wouldn't want to forget about that. So in the beginning, let's go back to the beginning. There was whole life, and I was around for this. So it was very simple back then. Whole life the basics of whole life are that premiums were paid for the whole of your life. There were other variations. There are other variations. There is a true 10-pay life, a 20-pay life paid up at 65. Those variations are guaranteed payment structures. Whole life has a maturity. Those maturity dates were set at age 95 or 100 generally. What does that mean to us? That means that the guaranteed cash value had to equal the face amount at that maturity date. And if the insured was still alive on that date, well, a check was written to the policy owner for the amount of that face amount. Well, that unfortunately undoes any estate planning that's been accomplished because everything's taxable at ordinary income rates over the basis. There are a number of guaranteed elements of whole life. The death benefit's guaranteed, The basic cash value as stated in the policy is guaranteed, and the premium amounts and the duration is guaranteed. The premium pricing of whole life is set assuming the carrier never earns over the guaranteed assumptions in the policy. It also assumes that there are no dividends or excess interest credits ever earned and put towards the policy. So the translation of that is while the premium amount is guaranteed, it's an extremely high amount. Dividends. What are dividends then? Well, dividends are a non-guaranteed element of participating policies. These dividends return to the policy owner some of this overpricing that we talked about in the premiums. The dividends are based on current mortality and expense assumptions, which are widely different than the guarantees. Options include reducing the premium, accumulating at interest, purchasing paid-up additions, as well as a few others, but those are the most popular. Flexibility of whole life. There's not a lot of flexibility because the premium amount itself has no flexibility. You cannot skip or defer premiums. They must be paid in some way. Whether you pay them in cash or pay them by a policy loan, it's got to be paid. A lot of the policies have what's called an APL provision, or an automatic premium loan. It was often standard on a lot of policies, which protects against a lapse. So if someone misplaces their premium notice and forgets to pay the premium, rather than having the policy terminate, a loan would be taken out against the cash value for the premium. But watch out, because a lot of the older policies had an extended term feature, which was different than the automatic premium loan feature. This was often standard, and what happened was if the client didn't pay the premium, the policy lapsed, and the cash value at the time of the lapse purchased term insurance equal to the face amount. The number of years that would remain in force would be based on the cash value and the age at the lapse time. Premiums, in addition to the guaranteed number of years that we talked about in the earlier slide of 10 years, 20 years, life paid up at 65, could be shortened up with what we call premium suspension. Back in the 80s, I think a lot of people might have heard the word vanish, and you'll see that that's crossed out. That is not a word we can say anymore. Premiums are suspended because they could come back. Dividends begin to purchase paid-up additions. And what happens is those paid-up additions increase the cash value and the death benefit. And at the time when a combination of the current year's dividend plus the surrender of the paid-up additions can cover all the future premiums, that's when the suspension occurs. So where's the risk here? Well, the risk is a reappearance risk of the premiums. If that dividend scale is reduced, and sometimes we're talking about 30 or 40 years of a projection, so it's a very long period of time that we're looking at. So if the dividends are reduced within that time frame, the premiums can reappear. If the policy owner is unaware, then the policy can lapse into extended term, or those additional premiums could be borrowed against the policy, either of which could cause a policy lapse. So the next evolution of whole life blends. This was introduced as a way to lower the premium amount of the whole life itself. It's a blend of whole life and term insurance. How does this work? Well, dividends will first purchase the target term amount. We'll have a base face amount of pure whole life. Let's say we have $1 million policy and $500,000 is whole life. The other $500,000 has to be made up of this target term. So the dividends will first purchase that $500,000 of target term, and the excess dividend, because the assumption is that at the younger ages, the dividend won't wholly be needed to purchase the term, that excess will purchase paid-up additions. As those paid-up additions increase, the amount of the target term needed decreases. But think of it, as you get older, the cost of the term insurance per thousand increases as we get older. So where's the risk here? We have seen over the number of years that we've done this, people bring us policies that have a 10-to-1 blend or a 90-10 blend. 90% term insurance, 10% whole life. That high ratio of term to whole life puts that whole target death benefit at risk. How does that put that at risk? Well, dividends can be and have been reduced over time. One of the main components of a dividend is the interest factor. The interest factor is based on what can the carrier earn on its underlying investment portfolio. So we all know those portfolio rates have reduced dramatically over the last 20 years. So if we have less dividends, we have less amount of paid up additions that can be purchased. So less paid up additions equals what? Well, a higher target term amount needed. The higher target term amount needed means we need to take more of that dividend to provide more of the target death benefit. So as you can see, we have what's called a reverse compounding effect. As those term rates increase due to age and more term is needed, eventually the dividend can't support the full death benefit. So what's the overall effect? Well, you have two choices. You can live with less death benefit and only the base death benefit is going to be guaranteed, or you can pay for the cost of the term at whatever age is needed. So if you're age 80 and your term insurance is gone, think of what it's going to cost you to provide term coverage at age 80. To exacerbate things, the underlying term rates themselves could change. The term rates per thousand could go up if mortality would change. So if that occurs, in addition to the dividend reduction, we just have a bigger problem.
So that's our primer on whole life. Tell us about universal life.
Universal life came out probably late 70s, early 80s, and at that point in time, there was a lot of people that were tapping their whole life policies and removing cash value because the whole life policies at the time had loan interest rates of 3 and 4%. And if we remember back in the early 80s, money markets were paying 15, 16%. So they'd take the money out of the whole life policy, put it in a money market fund, and have an arbitrage of 10 or 12%. Well, that caused a run on the bank, and insurance companies had to compete with this change. So they brought out Universal Life. Universal Life is a permanent insurance product, and it's probably one of the most ones we see. When people say they have whole life, we often see that they really have Universal Life. It's a permanent product which offers flexible premiums based on the policyholder's objectives. Key features of the Universal Life. Whereas in whole life, you can't really see what components of your dividend are made up of mortality, expenses, and interest. Here, the Universal Life product is totally unbundled. It specifically separates and identifies all of the expenses, the mortality charges, cash value parts of the policy, and I like to think of it very simply as term insurance with a bank account. So we've illustrated that term insurance with a bank account here with our leaky bucket. We're going to add to the bucket our premiums that we're paying every year and our interest. And we're going to take out of the bucket the mortality charges and expenses. And on the back end, if the policies were surrendered, there are sometimes surrender charges assessed. We have a lot of flexibility with Universal Life. Death benefit options in Universal Life can be level, they can be increasing, which is equal to the basic face amount plus the cash value, and often there's a return of premium death benefit, which adds up all the premiums you've paid into the contract and adds that to the basic face amount. A component of Universal Life is the interest factor. This interest factor is based on the earnings of the carrier investment portfolio, similar to the interest factor in a dividend. What can that carrier's investment portfolio earn? And that's what they're going to pass along to the policy owner. There's a guaranteed minimum rate of 2 to 4%. Back in the 80s, you will see policies that were 4.5%, 5%. Mortality and expense charges have two sets of assumptions. There's two tables. One is the current table, which is what is mortality running today for that carrier, and what is the guaranteed assumptions. And all the carriers today, all the products have to be based on the same mortality table. The big difference here between whole life and universal life is the flexibility of the premiums. premium amounts are flexible. There's no set amount. Within a minimum and a maximum range, you can pay whatever you want. And you can adapt that minimum and maximum, or you can adapt your amount you're paying every year to your changing circumstances. So how do we initially say what we're supposed to pay? Because that's a big range there. Well, we have to have a set of assumptions. What's our current or alternate interest crediting rate? So let's say the insurance carrier is currently crediting 5%. Do we feel that 5% long term is a viable rate? If not, let's look at something less. What are the current mortality and expense charges? And then we're going to compound that out and figure what we need to put in the policy to maintain that policy. If we look at it on a comparison basis to whole life, the premiums, generally speaking, are lower than whole life on what we call a life pay basis. If you're paying every year for your whole life under current interest and charges, the premiums would be lower. If we're looking at it under guaranteed assumptions under both products, the premiums would be similar, because remember, we're taking it down to where nobody's ever earning any excess interest or any dividends. We can overpay in universal life to shorten up our premium payment period. It's similar to adding the paid up additions to the whole life policy. One big difference here is that we can skip premiums without incurring a loan on the policy, and we can make those premiums up with interest at a later time. Big advantage here is that our death benefit is not reduced by a policy loan if the person dies while that premium's outstanding. We also have death benefit flexibility. We can decrease or increase that death benefit as we desire. Increases are subject to evidence of insurability, decreases are not. We also have cash value access during the insured's lifetime. These policies are designed for it. After a certain period of years, usually 15, 20 years, these policies have what's called wash loans. Let's just say you pay 4% interest and you get credited with 4% interest. So you can access your money from the universal life policies while you're still alive and still have some death benefit remaining to satisfy multiple objectives. Our next slide shows what the mortality charges for universal life look like. And I just took, I think, at age 40 and ran it to age 100, and you can see it's similar to buying a term insurance policy on a per thousand basis. How does that work within the policy? Well, if we're doing on what we call a life pay example, the red line there is the level premium that we need to put in that policy. You can see that overfunds the policy for a number of years because our cost of insurance is less. And then there's a crossover point where our cost of insurance is significantly higher. Well, at that point, that's when we're hoping that that cash value, based on the original projections, is enough to be able to support those increased cost of insurance charges. The cost of insurance charges are assessed on what we call the net amount at risk. And an example here is a level death benefit policy, and the premiums are paid for life. So if we have a $1 million policy and we're paying that level premium, the charges are assessed on the difference between the $1 million and the cash value. So the greater the cash value of the policy, the less amount on which you're assessed charges. So let's take that one step further, go to the next slide, and show you a maximum funded policy. This is the other end of the spectrum. We're putting in what the maximum allowed by law is. So you can see the significant overfunding, and we're paying this for a period of 7 years. Well, we've put that in, but now notice what happened to our cost of insurance. It's significantly less in those later years. That's because we have, and if we go to the next slide, you can see our cash value has grown substantially, and that red portion there, which is our net amount at risk, is very minuscule. So you have a lot less on which to assess those charges. So now the policy becomes so much more efficient. So where's our risks in universal life? Well, the biggest risk we see is a lapse risk. If those premiums plus the cash value are insufficient to cover the policy charges, the coverage terminates. And I can't tell you how many times we have heard from new clients, well, I paid my premium every year. How could that possibly happen? Well, if your policy hasn't been monitored, which Rachel will talk about, then the interest rates have probably come down. And if premiums haven't been increased at some point in time, we may run out of cash value. So at this lapse date, you could either pay the cost of insurance, which again is like buying term insurance at that age, which is probably not affordable. And think about those minimally funded policies that were illustrated in the 80s. I remember when interest rates that were being credited were over 11%, and now they're down to about 4%. Think big increase in premiums, or you better have a death claim prior to the lapse age.
Was there a way to guarantee universal life policies won't lapse?
Well, I'm glad you asked that, Craig. Insurance companies came out with a product to help mitigate that lapse potential, and it's called No Lapse Universal Life. No Lapse Universal Life, it's a completely separate product. It adds another guaranteed element, but it's at a price. It has a higher premium than traditional universal life, still usually lower than whole life, and we like to think of it simply as term insurance for life, because most of the policies out there have little or no cash value, and it's not a very flexible product. It does have guaranteed death benefits and guaranteed premium amounts, assuming all premiums are paid on time each year. So when is guaranteed not guaranteed? I'm sure that was the next question you were going to ask.
It was.
When premiums aren't paid on time, that's when our guaranteed goes away. Well, you might say, what's the definition of on time? Well, it depends on the carrier. And within carriers, it often depends on the product within the carrier. And it's important to ask the carrier what that definition is, because oftentimes you're going to find that it has to be on the due date, not one day earlier and not one day later. And yes, even paying earlier in some cases can negatively affect the policy. So our advice is request an INFORCE illustration for these policies. Even if you think it's guaranteed, let's just make sure that the guaranteed period is still the same as you originally wanted it to be, because you don't want to be in for a rude awakening.
As our time permits here, I know there's a lot of different flavors of universal life. Let's take us through a couple of those if we can.
The next variation of universal life is called variable universal life. And what that does is it takes the basic universal life chassis, and instead of having the cash value invested where the insurance carrier is giving you a crediting rate, you get to direct where the cash value is invested in various financial instruments offered by the insurance company. We've seen 30, 40 different options, and you can shift it around as you wish, but this shifts all of the risk to the policy owner, because while we now have unlimited upside potential, we also have unlimited downside potential. So let's remember that if we lose 20% in 1 year and then we gain 20% in 1 year, it doesn't equal zero. Compound that with our reverse compounding effect. Remember that net amount at risk charges in the chart and the mortality charges. The bigger the net amount at risk, the more the mortality charges, and we have a reverse compounding effect. So there's additional charges in variable universal life versus regular universal life, and those include the charges here of investment management fees and an additional mortality and expense risk charge. The keys to keeping a sound variable UL: start that hypothetical investment rate initially on a conservative assumption. You are still allowed to illustrate up to 12%, but don't do that. Let's stress test the illustration at various rates. And finally, monitor it. What does it look like versus what it was supposed to be looking like? And finally, today we have what's called indexed universal life. This is I like to think of it as somewhere between variable universal life and regular universal life. It combines some of the downside protection of a universal life with some of the upside potential of a variable universal life. How does it do it? Well, it credits the policy with a rate of return based on the change in an equity index. Carriers are offering sometimes 5 and 6 different equity indexes, such as the S&P, an international, a 2-year, a 5-year index, a lot of different choices. There's a cap rate, maximum earnings per year. Those cap rates can change. They're currently between 9 and 11%. Here's the good thing. There's a floor. The yearly earnings cannot go below zero. And for any of our variable universal life clients who have experienced the 2008 drop in the stock market, a 0% return sounds wonderful. So how does this work? We deposit our premium into a specific index account chosen by the policy owner. There's also a fixed rate account usually offered, which is similar to a traditional universal life. Then at the end of the segment, which is either your 1 year, 2 year, or whatever the segment rate length is, that growth rate is multiplied by a participation rate. So some have 100% participation rate, some have 90%, some have 150%. That participation rate then multiplied by the growth rate, the product of those two is the policy growth rate, and that growth rate is applied to the cap and the floor. This retains all the flexibility of our traditional universal life, but again, I can't stress enough, it should be on conservative assumptions, and we need to monitor it.
Okay. Well, what if I have several products already in place? What do you ladies expect me to do next then? Maybe Rachel's going to help us at this point.
Absolutely. As Donna has mentioned, insurance is not a set it and forget it product. It needs to be monitored. So if you have a portfolio that already has life insurance policies in it, it needs to be monitored again and again. Oftentimes, as Donna has mentioned, we find that life insurance is the least reviewed financial asset in one's portfolio. However, you may be relying on this death benefit to fund important goals and objectives. Oftentimes, we find that clients rely on automatically generated annual reports or correspondence from the life insurance carrier, but they are not necessarily reading these documents or possibly not truly grasping the content. Any life insurance review should have at least 5 components. The first being the product. Did the product, as Donna went through all of the products, as you can see, they have different flexibility, they have different characteristics. Was the product that was chosen meet the client's original objectives? And more than likely those objectives have changed, as well as maybe what you're looking for in the future. So you want to take a look and see if you want to access the cash value, if you want to be able to skip a premium, or if you're looking for a guarantee. Does the product that you have fit your current goals and objectives and your future ones if you know them? Even some policies that were issued 20 years ago could mature sooner than what you're going to find people are living much longer than they used to live. So you want to take a look at the maturity age. The second component should be performance. How was the policy originally designed to do, using what assumptions, and what does it look like today? And the way to do this is through an INFORCE illustration prepared by a life insurance carrier. You want to take a look, as Donna has mentioned, you could have variable life. Somebody could have sold that at 12%. What did the investment choices do? Did they earn 8%, and how does that affect the policy? Or oftentimes we'll find, oh, well, I'm going to pull out retirement benefits, or I'm going to pay for my son's college. Well, you could be relying on getting access to that cash, and maybe it's not as flexible as you thought it was, or maybe there's just not enough value. And the worst is that we find that policies will actually lapse much sooner than people anticipated. The third component is, okay, what can we do? So we now know the performance of the policy, but are there enhancements that can be made? Such as, is the carrier offering an internal replacement where there's less medical evidence? Or does the policy have a death benefit option of increasing, and you don't need an increasing death benefit any longer, so it's driving the cost of the policy up? So maybe we want to levelize the death benefit. Or perhaps you don't need as much death benefit, so maybe we'll have a reduction in death benefit. Or can we increase the premium? There's enhancements that can be made to your policy that may be able to get the policy back on track, meeting the goals and objectives. The fourth component of a review should take a look and see if there's a more competitive product. 20 years ago, we used to have standard tobacco and tobacco underwriting, and now we have a slew of different underwriting options. So you want to take a look, and if the insured is insurable, is there a more competitive better performing product that offers underwriting that would, instead of having to increase premiums on your current policy, we may be able to save some premium dollars and get the same amount of death benefit. And the fifth component should be to take a look at the life insurance carriers. Just like with banks, we're seeing in the life insurance industry carriers merging. So you're going to want to take a look and say, what is the likelihood that my life insurance carrier is going to be there when I pay a death claim? What is their general account invested in? What is Standard & Poor's? What is AM Best rating the carrier? And make sure that the carrier that you have in your portfolio matches your risk tolerance and your goals and objectives. We have found in doing reviews we put together a list of common life insurance mistakes and tax traps, and that's up there on the slide. We're going to briefly discuss each one of them. The first one is insured's estate as the beneficiary. This could subject the policy proceeds to probate, claims, and taxes. The second mistake is that no contingent policy owner or beneficiary is listed. If an owner predeceases the insured, the policy will pass to the successor owner. If there isn't a successor owner or contingent owner listed, it will pass through the owner's will, and therefore an unintended owner could end up being the owner of your life insurance policy. The third mistake is insurance owned by the insured. The proceeds will be included in the estate of the insured, which will increase the estate's value. If the estate is greater than the federal exemption amount, this could drive up federal estate taxes, which will be due on the proceeds. The fourth mistake is irrevocable trust owned. However, there's no administration ever completed. As you know, with life insurance that's owned by an irrevocable trust, there's proper notification that is necessary. If it's not completed, the policy will be included in the estate, and the same consequences I mentioned on the last slide will happen in this situation. The fifth mistake is the unholy trinity. This is when three parties are designated, such as one owner, a different insured, and then a different beneficiary. This will cause an unnecessary use of lifetime exemption or gifting. You see the same thing in the business marketplace, where there's an unholy trinity. This would subject the proceeds to income taxes to the beneficiary. The sixth mistake is the 3-year inclusion rule. This is when the insured dies within 3 years of transferring the policy. The policy proceeds will be included in the estate of the insured and subject to estate taxation. A better idea may be to take a look at selling the policy in order to circumvent this situation. The seventh mistake is split dollar issues. We have and administer over 500 split dollar policies and arrangements. Split dollar, we can have an entire webinar, Greg, on split dollar. There are 3 different arrangements that fall into different rules and regulations. You have old plans, which were issued prior to 2002. You have interim laws that are issued between 2002 and 2003, and then the final regs, which came out in 2003. And if you are not up to date on the rules and regulations of each of these different time periods, you could be violating split dollar rules. Some things that we found is that no economic benefit has ever been accounted for, issues with not putting it through an irrevocable trust, or if there's a majority shareholder and the policy is included in the estate. Other things that we've seen is it's so important to track the premium and the economic benefit, as the cash value of the life insurance can be included in the financial statements, but if you don't track it accordingly, you could be reporting the wrong number. The 8th mistake is the transfer for value. This is if a policy is transferred after the initial purchase for valuable consideration, the transfer for value rule will be triggered, and the death benefit will be subject to income tax.
What are the most common uses you folks see for insurances or insurance products being used in businesses?
with a business insurance, there's a number of ways that businesses utilize life insurance, such as funding a buy-sell agreement, putting key person insurance. But I'd say the most popular one is funding non-qualified plan liabilities. And it's informally funding non-qualified plan liabilities because it cannot be formally tied to the liability. However, it makes a great asset of the corporation. It can be, the cash value is used to strengthen the balance sheet. And we found that a majority of non-qualified plans out there are informally funded by some sort of permanent insurance. Why is it attractive? Well, premium dollars can be converted to cash value. That grows tax deferred. Investment earnings that would normally have been taxed now can accumulate on a pre-tax basis inside the policy. Plus, let's not forget, there's an immediate death benefit payable to the corporation upon the insured's death. We could have an entire webinar on non-qualified plans, but one of the most important notes that I'd like you to take away is if you do have any of this, have all the insureds signed a consent for 101J compliance. When the Pension Protection Act came out, it brought into existence this 101J compliance. Everybody has to consent to having a life insurance policy on their life. This was due to, again, abuses back in the 80s when insureds weren't even aware that they were being insured for life insurance, and corporations put thousands of policies on everybody, including the janitor. So those abuses have stopped, and now you must have everybody sign a consent. The next thing I want to say is don't minimally fund the policies. Don't make them so skinny in the premium department that we have a potential lapse. And let's not assume that people will die too early. Oftentimes I've seen plans where people say this is what's funding it, and the person who ran the illustration said, oh, everybody's going to die by age 85, so they funded it assuming that. Well, that gives additional risk to the policy. Let's assume everyone reaches at least the ripe old age of 100 or more.
We hope.
We hope. And again, it's so important to monitor the policies in our non-qualified plans. What's the investment allocations if they're variable policies versus the projected liabilities? When's the cash flow needed? How is the cash flow going to be needed? Is it supposed to come out of the policy? Well, if so, let's make sure the cash value can sustain those withdrawals and loans against the policy. And let's not let those policies lapse. Because if we take withdrawals and loans from a policy and the policy lapses, well, all that accrued loan interest is being added to the loan. Anything over basis that's taken out as a loan will be taxable. But now you have no cash value to pay the tax. You have zero cash value and have all this phantom income, so you're going to get a big tax bill with no dollars to pay the tax.
Well, let's. We appreciate the overview, and but we also have a little bit of time here. So tell us a little bit about 1802 insurance and kind of your approach to this and the types of companies that you work with in serving clients.
Absolutely. 1802 Insurance is a new division of Cornerstone Advisors. Traditionally, through Cornerstone Advisors, we focused on the business and estate plans and then looked at the insurance planning services. What we're doing through 1802 Insurance is we are unbundling this, and we are offering professional insurance services separate from the business and estate plans. We are true insurance professionals. You can rely on us. And we've been doing this for many years, and we have an extensive life insurance background and understanding. We are powered through M Financial, so we have an office in the Lehigh Valley, but we also are part of a national organization that is the nation's leading financial service, design, and distribution company for the ultra-affluent marketplace. M Financial is made up of member firms like 1802 Insurance, and their mission is to assist us in providing you with additional value. We have a team of 200 professionals in Portland, Oregon that is dedicated to supporting M firms. We have actuaries, we have underwriters, we have teams dedicated to product development, underwriting, finance, and reinsurance. M Financial has 6 partner carriers, as well as associate carriers and specialty carriers. We focus on all the life insurance that Donna talked about: traditional universal life, variable universal life, index universal life, term insurance, as well as private placement, disability, and long-term care. What makes M Financial and working with 1802 Insurance remarkably different is we have access to exclusive proprietary products. Proprietary products are designed much differently than traditional life insurance. So with a proprietary product, it is priced using the 30 years of mortality, persistence, policy size, and expense experience of M Financial. With a traditional life insurance product, you use the general population statistics. And what we have found with the pool of insureds at M is that we have higher face amounts, we have lower mortality, as well as we keep our policies on the books longer. And all of this means is that we have a lower underlying policy expenses. This is fabulous when a policy is priced, but what happens 10 years from now when people are living even longer due to healthcare or new technologies? What they actually do is we have M as a watchdog, and we'll look at the life insurance carrier and say we've had better favorable experience, and our existing policyholders should be able to experience that. We have had over 54 repricings in the proprietary marketplace, which have cost reductions totaling $200 million. This is remarkably different of what you find in most life insurance carriers. They tend to reprice, they tend to utilize that savings and develop a new product to entice new sales. Within M Financial proprietary products, the existing policyholders get to reap those benefits.
Okay. Well, while our contact information is up on the screen, I'm going to turn it back over to Tyler for a couple of housekeeping details. We do have about 4 questions that have come in, and we're going to address those as many as we have time for. If you have a question that you haven't submitted yet, now would be a good time to do that. We'll turn it over to Tyler, and we'll be right back for these questions. And we'll just take them in the order they came in here, and this is the first one. It sounds like what you're advocating is similar to the steps outlined in the Uniform Prudent Investor Act. My favorite act. I have that memorized. Is that the case?
Yes, that's a great question. A lot of trustees out there don't realize how much they have a fiduciary responsibility under this act for the policies of which they administer in the various trusts that they are the trustees of. So we also offer these services to the trustees of the irrevocable trusts to help them meet those fiduciary responsibilities. Most of the trustees are not insurance professionals out there, so they don't know the questions to ask. And we found insurance companies, when you ask questions, will just give you the answer to what you've asked. So if you ask for a current INFORCE, that's what you're going to get. They're not going to go back and look at how the original design was. They're just going to give you the premium as it's today, paid forever. So it's important to know what was the original design, what do I want to ask for as far as INFORCE illustrations, and just to know the questions to ask. So how do we do that? Well, up front, do your homework up front. Ask questions when the policy is first being issued. Monitor it, and work with an insurance professional when you have questions. Don't hesitate to reach out. If you've got any kind of questions on a policy, you don't know what something means, reach out to your insurance professional.
This sort of ties into the second question, so let me just ask them a little bit out of order here, but this question that you just referenced. Person's asking, how often should a policy be monitored?
So a policy, when it's originally issued, should be monitored. It depends a lot on the policy itself, okay? And this triggering events that I would say is that if there's a marriage, if there's a divorce, if there's a new addition to the family, if there's a life change like retirement or a risk tolerance change. And it depends a lot on what the review is showing, the first review. So when you issue a policy, in the next 2 years, get another INFORCE illustration and see what it looks like. If you're invested in investment choices tied to this, the funds that Donna has mentioned in variable universal life or indexed universal life, you may want to do it more regularly depending on what's happening in the economic environment. At the very least, you're looking at every 2 to 3 years at taking a look at a life insurance policy, but you're also going to want to look at those life events as triggering points that you may want to look at it more frequently.
Okay. Again, the next question ties a little bit to that, but just what if you don't know how to contact the selling agent, or he or she's no longer active? What if my agent's had some life change events and I can't get a hold of them to do this?
Well, as Donna's mentioned, I'd work with a life insurance professional who's willing to take a look and provide a review, or you can try to contact the home office. But again, and what we have found, you have to know what to ask when you're dealing with the home office and the life insurance carrier.
Okay. Fourth question, how do you know, I mean, we've covered a lot of different products today, and can you give at least a brief answer of how you would know which product would be included in an insurance portfolio?
I think it's important in that question to know what your objectives are, such as, do you have a budget for your premium? That's first and foremost. What's the objective of the death benefit? Is it to cover a loan? Is it for a finite term? Is it to cover estate taxes where you know your estate's not going to shrink and the coverage needs to be there forever? Do you want to take income out of the policy? Do we want to pay for only a certain number of years? Let's say we want it to be, we don't want to pay after retirement because we know we're going to be on a fixed income. All of those things will play into the product selection. And then finally, what's your risk tolerance? Can you afford to stomach those downturns in the market? Because if you can't, let's gear everything towards more of a safe, risk-averse type policy.
Okay. Excellent. I'm going to ask, or Tyra's going to just keep up the slide that's got the contact information here. We'll see if there's a couple other questions. A couple of them have some specifics that I'm going to let be addressed here, if probably directly by our guests here, back to the individual. So we do have your contact information for some of those questions. This question has just come in while we've been talking. It's this one. What if a person is 95 years or older? And I'm going to read the question as it's written here. It's kind of paraphrased. What if a person is 95 years or older? Is the whole life check cut by the company automatic, or is there a POA responsibility to contact the policyholder?
What I would suggest is taking a look at the actual policy and calling the carrier. Typically, if the policy matures, the cash value is sent to the policy owner. So, but what we have found, some life insurance carriers are offering some type of extended insurance past the original maturity date. So take a look at the original policy so you know what was originally issued, but then call the life insurance carrier and get something in writing as to what happens exactly at age 95 or whatever age maturity is in the policy.
Okay. And this question has also just come in. How important is it to market your case to the insurance company?
That's a good question. You know, oftentimes we're not all in the picture of health, or some people have avocations that might warrant a rating, such as scuba diving or aerobatic flying or hang gliding, bungee jumping, things like that. All of those can make underwriting difficult, and combine that with any kind of medical situations and it becomes very difficult. So it's extremely important to go to multiple carriers and to have your case packaged by someone who really understands what they're doing. For example, we have an underwriter on staff who will take a look at all of the underwriting and package it and put it to a number of different carriers, knowing the questions that they're going to ask. She'll already have those answers. And if someone is a part-time pilot, well, the number of hours can be crucial to getting that policy issued with or without a rating, things like that. So, yes, it's very important to package it correctly and to definitely go out to more than one carrier.
Okay. Well, we thank you both for being here with us today. Your contact information, again, is up on this slide. I think the people that have registered and signed on for this, feel free to contact you directly. Is that okay with you at these email addresses, these numbers?
Absolutely.
I could do the same for me. And again, we thank you for coming. We're thankful to be able to serve many mutual clients together. We have a lot of respect for your organization and the value to bring to your clients, and we thank you for sharing some of that with us today with our client base and those that are signed on. Rachel, Donna, any closing words for the listeners?
No, we just want to thank you for having us here.
All right.
Absolutely. We'll look forward to hearing from you.
Okay. Thank you.
Thank you once again for joining us for this presentation produced by McKonly Asbury. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.